Hi, I'm Scott Rickel. Welcome back to the Hegg blog. This week talking a little bit more about buying power and how the market affects your buying power. If you were paying attention last week, you might have noticed that 30-year interest rates dropped as low as they've been in 55 years. It just briefly held there and came back up a little bit, but still rates are incredible right now. Just wanted to demonstrate just a little bit about how much interest rates and a couple of different factors, how that affects your buying power right now in today's market. If you had purchased a $150,000 home with a 30-year conventional mortgage, let's say maybe about 7, 8, 9, 10 years ago, rates were more up in this level, about a 7% or so, you would have paid a monthly payment of about $1,000, including your property taxes, your insurance, and probably some PMI, which you pay, of course, if you don't have a 20% down on your loan. So about $1,000 on that. A few years after that, as rates went down a little bit, that same loan you probably could have refinanced to about $805 a month, also including tax, PMI, etc., at 5%. Now, 3.75 is a rate that you see a lot of just this last week or so, and now that same house, $695 would be the monthly payment. So if you work your budget out by just monthly payments, as a lot of people do, this is the difference that just an interest rate can make between those. And by comparison, that's $150,000 house that you bought 8, 9, 10 years ago and paid $1,000 a month for. If you were still looking for a $1,000 a month payment today, you'd be shopping for a $217,000 house and still get a $1,000 payment on it. Of course, you're going to need a little bit higher down payment. That's even adjusted to have a little bit higher property taxes in it too. So it's a pretty dramatic difference in what the buying power was from back then to today. Also, a lot of us look at, I have this $150,000 house and I'd like to move up to, say, something in the $250,000 range, but I'm worried that the market is down as far as sales prices, and in fact it is a little bit. So if you are moving up, this is something, I've talked about this before, but just one principle to keep in mind is you're trying to sell your $150,000 home and it's 5% off as a general market. Just as an example, you're leaving about $7,500 on the table there. So that's reducing what you're taking away from the house. But if you're moving up to $250,000, that seller, if they are also 5%, and the fact is they're probably more than that off of that, so they're leaving about $12,500 on the table, which is a net gain for you of $5,000 in the transaction. So there is a way that it washes out in the end if you are in fact moving up to a higher price range, is that if you're sacrificing something on your end to get yours sold, you're probably making all that back, and if not more, on the purchase end. So keep that in mind. But buying power is great today, so if you're looking, let us know. Glad to help you out. Thanks.